If you saw my last presentation, this slide should look very familiar because I talked about it then. Today, I quickly want to go over it in a little bit more detail because it's a question that keeps coming up. Specifically, with rates as high as they are right now, you can get 5% or more on a short-term CD. So the question then is, why don't we sell everything and just go buy CDs and not mess with any of the other stuff? It's a seemingly attractive proposition, so why do we think that's such a bad idea? This slide lays out our general philosophy. So specifically, what are we looking at here? We're looking at the past Fed rate raising cycles. So there's been several times in the last 30 plus, or actually I should say 40 plus years, where the Fed has raised interest rates. That's the situation we're currently in. Fed started at 0 back in 2020, and today we're up over 5%. What happens when the Fed is done raising rates? And that's what we're looking at here. So this, we'll call it a diamond, is peak CD rates. So this is the highest that CD rates got during this time period. And this gray bar shows what is the 6-month CD return in the 12-month following the last Fed raise. So in this scenario, it would be like if the Fed stopped raising rates with their last hike, what would the returns look like in the 12 months going forward? And now what we see is that with the CDs, when you buy a CD, especially a short-term CD like a 6-month CD, price is what the price is, especially if you hold it for 12 months, because it's going to mature in 6 months. In 6 months' time, you go buy a new one, and you're going to get whatever the prevailing rate is. But what typically happens following a series of rate raises is that rates start to come down. And when rates start to come down, the shortest bonds, or CDs, don't change in price. The shorter a position is, the less price fluctuation you get. This is good when rates are going up, but it puts you at a disadvantage when rates are coming down. Because when rates come down, bond prices go up. So let's say, for example, that you have a 10-year treasury, $1,000 of a 10-year treasury, it's paying you 5%. You're going to get $50 a year of interest come hell or high water. Now, all of a sudden, interest rates come down to 4%. The new bonds pay $40 a year. Someone looks at your bond and goes, okay, yours pays 50, the new ones pay 40. If I buy your position, I'm going to get an extra $10 every year for the next 10 years. Therefore, even though you bought it for $1,000, I'm going to give you $1,100. So on paper, it looks like your CD, or your 10-year treasury, I should say, has gone up by 10% in the blink of an eye. Now, it was always going to be a 5% annualized return, but that's not what we're looking at here. We're looking at annual returns over a 12-month period following the end of the Fed rate raises. So again, when you own a CD, and a short CD at that, as rates start to come down, one, you do not get the advantage of interest rates coming down and your prices increase in the short run. You're also disadvantaged by the fact that when your CD comes due, you're forced to reinvest it at whatever rates are out there. And if rates are coming down, you're forced to reinvest at lower rates. So now you have to ask yourself, if I'm investing in CDs, what am I going to do when rates come down? Now, if interest rates go way back down to 0 and you're in a CD and all of a sudden you're forced to reinvest at 0% interest, well, are you going to go back into the stock market? Are you going to go back in the bond market that now has 0% interest rates? Are you going to go longer on the yield curve to try to find some yield? Are you going to go sneaking into high yield trying to find some yield? All these things are going to seem very, very unattractive after rates have gone down significantly. So again, we stay the course on our long-term plans despite the fact that rates in the near term are higher and CDs look really attractive. And what we've seen historically over the last 40 years is that following every Fed rate raising cycle, over the next 12 months, the aggregate bond index, a broad swath of the bond market that has a longer duration than the CD market, has significantly outperformed CDs. So even if you wanted to stay in the bond market, it doesn't make sense to just go into CDs, because what you're doing is you're essentially paying a lot of money for the insurance of seeing less volatility in your account. You're potentially restricting your returns significantly over what you would have if you maintained a more traditional bond allocation that we would expect in really any other interest rate kind of environment. So again, here, blue bar, Bloomberg U.S. Aggregate Bond Index, a large swath of bond market. I believe the average duration is typically around 6 years. In every environment historically that we've seen, it has outperformed the 6-month CD. We look at the S&P 500. It has historically done well in the periods following when the Fed is done raising rates. The S&P 500 has typically done well. Obviously, it's not a surefire thing. In 2000, the S&P was down 11% in the 12 months following the Fed being done raising rates. So again, we're not saying load up on stocks. We're not saying that you have to do anything heroic. We're simply saying that taking too much risk off the table, focusing too much on short-term CDs today in this very moment when they seem attractive is something you need to be cautious of, because what seems like taking little risk or taking risk off the table could be adding significant risk to your long-term plan if you define risk as potentially running out of money in retirement, or the risk of having less than you need to cover your expenses. So again, this is why we do not load up strictly on CDs, especially short CDs. And if you have any questions about this or anything else, just let us know.